Welcome everyone to our continuation of our discussion of stock compensation and earnings per share. We're moving on to the calculation of complex capital structure or diluted earnings per share. That means that there are some dilutive securities, and so there are some guidelines or rules about how we utilize them to calculate our earnings per share. So remember, we've already calculated the basic earnings per share. That's our starting point. We have a weighted average shares outstanding on the bottom. We have net income minus preferred dividends on the top, or the numerator of our calculation. And so we're going to start with stock options. You always want to start with stock options or warrants in calculating your diluted earnings per share. So they are dilutive if the exercise price is below the average market price. So if the exercise price, that's the price at which the employee can buy shares in the agreement, is below the average market price for the year for the stock. And those will be given to you in your problems or homework and things like that. So if it's dilutive, then we go forward. If it's not, if the employee can buy the shares at $20, but the average price is $15, what dumb employee would do that? So that's not going to happen, and therefore we ignore those that are in that situation. That means that they are not considered in this step of the process. And if all of our options are like that, then we can move on to the next. We can ignore options altogether. So if they're dilutive, meaning that the exercise price is below the average market price, then we're going to use what's called the Treasury stock method to determine how many additional shares we're going to add to the bottom of our EPS calculation, our weighted average shares outstanding from basic, or how many shares we're going to add to that. Nothing with having to do with stock options affects the top or the numerator of our calculation, only the denominator or the bottom. So first of all, we figure out how many shares will be issued according to the number of options we have, and then we subtract from that shares assumed to be repurchased. So what's going to happen is we're going to assume, or we're pretending, that all the people who own the options are going to turn those options in and buy the shares of stock for cash. That means they're going to turn in the amount of cash that they equal to the number of options times the exercise price. We take that proceeds and we then use that money or that cash we receive to buy back other shares so that we can minimize the amount of the dilution in the market. So restricted stock that is unvested is also included with the market price at grant. Remember, the market price is a fair market value at the date of grant times the number of shares as the proceeds. So again, we would take the market price at the number of grant times how many shares. We assume that the employees are going to pay that or receive compensation of that amount. We're going to use that to buy back other shares. So maybe it'll be a little easier when you see an example. So let's look at an example, exactly the example given in the codification for showing us how to do this. So we have 10,000 warrants outstanding, exercisable at $54 a share. That's the exercise price. The average market price of common stock is $60. So first question, are they dilutive? And the answer is yes. The exercise price is 54. The average price is 60. It's lower, therefore it is dilutive. So if we assume the exercise of the warrants or stock options and issuance of the 10,000 shares, so they would give us $54 per share for 10,000 of them. That's $540,000 that the company would receive when those shares were issued. So that's our assumption. That actually hasn't happened. We're pretending. Remember, this is a exercise in pretend. And then the amount would then allow us, we take that 54,000 and we would buy shares, pretending again that we would buy shares at $60, the average market price, and that would allow us to buy back 9,000. So we would issue to employees 10,000 shares. We would buy back 9,000 from other shareholders, and therefore our total number of shares would only go up by 1,000. That's going to be added to the denominator, the bottom number of our earnings per share calculation to get the diluted number. So whatever that weighted average was we're going to add 1,000. So there's how you do the Treasury stock. And it's named that because you assume you're going to buy back shares into the Treasury. All right. So the other ones we need to worry about, and this is, we did stock options and stock warrants, restricted stock, all kind of are handled the same way. Now let's look at convertible bonds and convertible preferred kind of together. So we're going to pretend, again, that they are converted. That means that they're going to be converted from bonds or preferred stock into common stock. So we're going to increase the numerator. All right, now that's different than stock options. We increase the numerator, the top number of our earnings per share calculation, by the amount of the preferred dividends, because if you convert the preferred stock, you're not going to pay any preferred dividends, or the interest that you would have paid on the bonds. If you're going to convert the bonds, you're not going to have to pay interest. Now, do not forget taxes when considering interest. $100 of interest is really only costs you, with current tax rates, $80, because you get to save taxes on the amount you pay in interest. So the tax rate right now for corporations is 21%, so you literally save $21 for every $100 of interest you pay. So really that interest only costs you $79. So make sure that you can deal with the taxes when you assume that they're converted. You increase the denominator, the bottom number, by the shares to be issued with the conversion. So there will be a conversion factor. You will convert each bond into so many shares of stock, or each preferred share into so many shares of common stock. So you just need to know how many of those are, multiply it by that conversion factor. You start this when the convertible bonds or stock are issued, and they end, of course, when they're converted into common stock, as far as your time period. So, example, net income is $2 million, preferred dividends $300,000, weighted average shares outstanding 1.3 million. So there's our basic earnings per share calculation. The preferred stock is $3 million with a $100 par value. Is all convertible to common shares at a rate of 10 common shares per preferred share. So there's our conversion rate. Preferred stock is outstanding for the whole year, so you don't need to adjust for the time period. You don't have to do it for part of the year or anything like that. If preferred stock is converted for the whole year, then the preferred dividends would be 0, and the numerator would be 2 million, meaning instead of 2 million minus 300,000, like it would be, it'd just be 2 million, because the preferred dividends would be added back, or however you want to think about it, or not subtracted in the first place. If preferred stock is converted for the whole year, then an additional 300,000 shares would be outstanding. How do we get that? 3 million divided by a $100 par value gives us 30,000 preferred stock number of shares, and each of those can convert into 10 common shares. So we're going to pretend that those were converted, which means we don't have to pay the preferred dividends, and you have to add more common shares to the bottom number or the denominator. So now your diluted earnings per share would be $2 million divided by 1.6 million. That's the 1.3 plus the 300,000. Notice with preferred stock, you don't have to worry about the tax issue. That's only for bonds, only for when there's interest, because preferred dividends are not tax deductible. Therefore, they have no tax effect. So a couple of things to remember as we wrap up here. Our second podcast, earnings per share calculation, is done in real life every quarter for on the income statement. Basic and diluted are computed each quarter and disclosed for both continuing operations and discontinued operations and net income. If you have discontinued operations, we talked about that way back when we did the income statement in about in about week 3. Discontinued operations must be separately broken out from regular continuing operations. If there's no discontinued operations, then you just have to calculate basic and diluted earnings per share for net income. But if you do have discontinued operations, you must do it for both continuing operations, discontinued operations, and net income. So you literally could have 6 calculations, basic and diluted for continuing operations, basic and diluted for discontinued operations, and basic and diluted for net income. All of those numbers would have that disclosure. All right, so remember, it's only if you have diluted securities that you need to do both. So some companies with a simple capital structure or no diluted securities will only have basic earnings per share. All right, but most big companies, most that you'll look at, will have both. Most of them have at least one of those diluted securities we talked about.